Talking about countries taking out debt, you would presume that this is one of the safest forms of debt structuring out there. But it appears as though, to me, there is generally a lot of volatility in bond markets, despite the fact that we're talking about issuers that are basically as big as it can possibly get.
Different parts of the bond market are quite different. So it's difficult to generalize in like broad strokes about the bond market as if it were one thing. There are some pockets of the bond market that trade like tech stocks, like truly. So when you're talking about Argentine bonds when they're nearing default, or Venezuelan bonds when they're nearing default, or countries that are in serious financial distress, those bonds can be extraordinarily volatile. You can have bonds go down to 20 cents on the dollar with some bad news, and then they jump up to 45.50 as soon as some like right-wing candidate that's promising more fiscal austerity is like going up in the polls. In like, let's say, U.S. bond markets for the U.S. Treasury, there are no fluctuations in like willingness and capacity to pay. Really, the volatility that you get is because interest rates are rising and falling because of Federal Reserve monetary policy and so on. So that's what drives volatility in advanced economies.